Hello YouTube, welcome back to another video. Today we're going to be doing our second video on the intro to the stock market. This is going to continue to be a series on the channel. I got a lot of positive feedback from the last video. I hope you guys keep enjoying these videos and I hope they're helping you guys learn stuff that you don't usually learn about in your lives. Today we're going to be doing lesson 3, which is types of investing. And without further ado, let's get straight into this. All right, investing versus trading. So these terms go around a lot when you're talking about stocks, and it's really important to make sure you know what the differences are. Investing is focused on acquiring a stock for long-term gains. Investors mostly ignore volatility and focus on the fundamentals of a company. Investors look for growth, value, and momentum. Trading is focused on earning profit from short-term runs, which last anywhere from weeks, days, or sometimes even minutes. They take advantage of mispricings in the market and usually stick to volatile stocks. Investing versus trading examples. An investor sees Amazon has a potential to grow as e-commerce markets play bigger roles in the future. Let's say right here in 2016, the investor held over 4.5 years and got a 496% return on Amazon. That's what an investor would do. They would wait an entire 4 years but they got this really nice return. Now a trader, what they would do is they see a dip in the price right here in the morning, and if they see that it continues to grow, they hold it, and then they sell it in the afternoon with a 2.4% return. Now this is significantly lower than 496, but look at the time. In 3 hours they got a 2% return, while in 4 years they got almost 500% return. So that's just something to keep in mind. Traders and investors, they have different mindsets, different risks. They're two different things. But today we're going to be focusing on investing. What is the goal? Investors always have a goal in mind before stepping a foot in the markets. They have to evaluate their current financial status and goals. For example, how much money are they willing to put in? Will they take higher risks for better returns? How much research must they do? The investors come from all different types of settings in life. Some have really good jobs, some are working 9 to 5. So you have to establish all these little things. How much research are you willing to put in? How much time do they have? Is it for retirement? Is it just a hobby? Is it for college? Another important factor is mentality. Investing is the real deal. There's potential to earn lots of money, but there's also potential to lose lots of money. The markets might experience recessions or severe dips, and the right mentality is required to make the best decisions. Emotions have to be controlled. That's one of the most important things any type of investor or trader can tell you. Emotions have to be under control, because if you're holding a stock and it drops, say, 5% in a day, if you know fundamentals, you have a solid understanding, you should not be getting scared. Research. Investors always look at market patterns and data to make informed and secure decisions. This is not gambling. Investing is not gambling. That's one thing that has to be clear. The decisions made have to be informed and secure. So more professionals or even amateurs, every time they're considering something, they read about it, they look at financial reports, they look at numbers, they look at graphs, they might consult with other people. But these are all things that have to play out before any decision is made. The efficient market hypothesis. The efficient market hypothesis states that asset prices reflect all available information. This means that beating the market is impossible because changes in the market are based on new information that changes the fundamental value. So this idea that asset prices reflect all available information is very much debated within the community of investors, because again, some people might argue that investors have considered all the factors and the number that you see is based on all those factors. But other people, critics, most notably behavioral economists, they might argue that imperfections in the markets are caused by overconfidence, fear, information bias, and just human emotion in general. Like if a stock dips 5% in a day and there's no reason for that, again, people that go against this hypothesis would say that it's due to human emotion or irrational fear. Warren Buffett, which is one of the biggest investors of all time, has argued against the efficient market hypothesis, claiming that value investors could beat the market without luck, as supporters of the EMH have stated. Value investors seek out companies they believe are undervalued. This can be caused by bad news, a market crash, herd mentality sell-offs, or simply lack of attention. They see this as a stock on discount, basically. They hold it for the long run, which is usually a couple of years. They do lots of research and use indicators such as the PE ratio and EPS to select the stock. Earnings reports and financial statements are also key components. So what I said, Warren Buffett is one of the best value investors of our times. Right here we have a value investing tool. Low PE ratio is often a good indicator of a strong undervalued company. However, critics point out to inflated earnings that boost the denominator, giving the false sense of the company. So for PE ratio, as an example, let's say company X earns $1 million in profit and they have 100,000 shares that you can buy in the market. And the EPS would be 10 because 1 million in profit divided by 100,000 shares, it gives you 10, which is earnings per share. So let's say one share of company X costs $55. The PE ratio is the price per share, which is 55, and you divide that by the EPS, which from the last part we calculated as 10. So 55 divided by 10 is 5.5, as you can see here on the screen. Again, that's one of the tools. There's a lot more tools that we're going to be talking about in future videos, like financial reports, but this is just one of the basic tools to get you started. Let's look at an example of value investing. Facebook has a strong EPS right here. We can see 8.78 and a low PE ratio right here, 31. Its dip at the start of the pandemic in March was an opportunity for value investors. The company has a strong foundation, a large audience, and strong earnings. So another thing to note is that value investors usually go against the efficient market hypothesis, the EMH for short, because again, they're looking at what they call undervalued stocks that are based on the EPS, the PE, and other factors. Growth investors look towards the future earnings of stocks, or quote unquote, the next big thing. Growth stocks outperform the average growth for the market. Growth investors look at companies that have room to expand in their industries and offer unique products or services. Growing companies usually don't pay dividends because they use that money to grow. And instead of giving it out to shareholders, they keep growing, which makes it a riskier stock if there's no dividend. There should be demand for the product or service that this company can fill when they begin to grow. These usually have a high PE ratio because their earnings, they're expected to grow, but they're not necessarily the strongest they could be right now. So let's look at an example of growth investing. Shopify has grown over 200% in the past year. So again, we're looking here. It has clearly outperformed the market. Very few stocks have gone up 200% in the past year. So we can see that it's outperforming the market. The PE ratio, if you look right here, that's pretty high. 597 is a pretty high PE ratio. The EPS it's pretty low as well. Again, it's defended with the argument that its profits are going to grow in the future. They're not here yet, but as it keeps growing, they're going to start coming in. And that seems like that's the end of the video. I hope you guys enjoyed it. Make sure, if you want perfectly, you can go back and review. Remember, value stocks are stocks on discount. They usually pay a dividend. They have low PE ratios, and they're considered safe. Growth stocks, they don't pay dividends. They have high PE ratios. They have they're quote unquote the next big thing, and their earnings are expected to grow in the future, even if they don't have good earnings right now. Just make sure to keep those concepts in mind. If you need to, there's websites in the description. You can type these terms into Google. There's lots of stuff you can keep learning about this. Of course, these go much deeper than this information. It gets much more complex, but right now we're just doing the basics. So I hope you guys enjoyed this video. Please stay tuned for more videos. Our next lesson right here, as you can see, is going to be active trading next video. So thank you guys for watching, and I hope to see you in the next video.